Hey everyone, thank you for joining. My name is Randy Eisel of Rolling F Credit Union. Welcome to our noon lunch and learn. Part of our mission of the credit union is to help our members reach a place of financial stability. And one of the questions we're trying to answer is, as we accumulate wealth, how do we use it and use the rules available to us to best advance us forward? So I'm totally thankful to have Wealthramp and Pam Krueger here with me today. She reached out to me just a couple of weeks ago, said, hey, I want to do this for your credit union, for your community. And I thought, hell yeah, that sounds exactly like what I want to do. So I'm really thankful, Pam. If you don't mind, maybe introduce yourself and what you do, how you're already connected to the credit union, and then just get us started for the rest of the afternoon.
Beautiful. Thanks, Randy. And Bobby, who's there from the credit union as well. I am Pam Krueger. I'm the founder of Wealthramp.com. I'm also the co-host of the Friends Talk Money podcast on PBS Next Avenue. So I want to basically explain a little bit that the reason that Randy and I know each other is because Randy was looking for the best possible solution for his credit union members to access financial planning and wealth management on a fee-only fiduciary basis, meaning that he wanted to make sure any advisors that he would engage to work with you in the community, that they are rigorously vetted and that they are competent and experienced in the areas where you need it. But most importantly, that they're not salespeople. They're not people who sell insurance. They don't sell products on commission, which really puts them in the role of advisors on a fee-only basis. So the nutshell is Wealthramp through Rolling F, right on the Rolling F webpage, homepage. Wealthramp is the place where you go when you're looking for the right financial advisors who I have personally vetted myself. And right now, what I want to do is I want to welcome everybody to our year-end smart money moves that you can still make before the end of the year and things to do to set yourself up for a super strong financial 2022. We're not going to get into minutia. We're not going to get you into the weeds. I promise. These are very quick, very practical, very actionable, usable steps you can take. And I've asked Eric Lai, certified financial planner and co-founder of Archfest Wealth Managers, or Wealth Advisors, I should say, in Walnut Creek. Now, Eric is an investment and a tax specialist, and he's accessible to each of you through Rolling F Credit Union and the partnership we have with Wealthramp. So again, you go to that homepage, you click there, and that's where you can get started to get really synced up with the right advisor for you. Eric's part of that network. So let's just get started. Eric, can you please share with us what you're going to tell your clients, or what you've been telling your clients before the end of the year, that they can actually do right now? And then one just quick little note I should have said, I promise we will have questions, a time for your questions when Eric is finished. So Eric, what's the best advice for people right now before the end of the year?
Well, Pam, thank you for inviting me today. I appreciate the opportunity to join you, Randy, and the credit union here. So thank you. December 31st is fast approaching. And what I'm telling my clients is, the actions you take today can have an impact on you, because when you file taxes, when you do these type of things, the IRS is going to look at things as of year end. Even though you have until next April to file taxes, the time to take action, the time to lock things in, are by December 31st. If it didn't happen by December 31st, it is not part of tax year 2021, and therefore part of next tax year. So there is kind of five top things, as I say, to work through before then.
All right, let's start with number one, which I have a feeling is going to be tax focused.
Oh yeah, you got it.
What's the very, very, very first thing that
number one is really centered around, as you mentioned, exactly, taxes, tax withholding. Most people think, the time to true up taxes is in April timeframe when you file taxes. But as people are working and receiving paychecks, they're doing a withholding on their payroll on a monthly basis. And it's important to gauge as you are going along in the year as to what your actual tax obligations are going to be versus what you have been withholding. And the last time to do anything about it is your December 31st paycheck.
And Eric, I have to say, I got this wrong. I'm really surprised that I got this wrong this past year. I do work with a CPA because, it's somewhat complex. And we withheld a little bit too little. So I wound up owing. But on the other hand, it's never a good idea. It's never a great idea financially to over withhold either, because you think it's exciting. Oh, goody, I'm getting a refund check. But when you get
it's your money.
Check, it's you're getting your own money back. You shouldn't have to pay in the first place, right?
The idea is try to get it as on target as you can. But for most people, it is, because the way that the tax code is designed, if you stack it up, it's a mile high. You're only going to get so close. So as I tell people, if you get close, that's probably as close as you're going to get. But the idea is to not owe and not get a refund. That is the ideal target. And that's why we usually, work with our clients at the end of the year is to really review their taxes, their taxable obligations, and do any true up that's necessary. Because in theory, it is possible for people to have under withheld on their taxes that end up paying a penalty. It is theoretically possible. So to do this at the end of the year is really just to take a review and to make any adjustments that's necessary, make corrections on your withholding, do estimated payments, whatever it is, to true things up to a degree where you avoid that surprise at the end when you file, because nobody wants to go into April thinking they're even and get a surprise tax bill.
That's
We
exactly
say
right.
surprises are bad.
Right. And I don't want to go into 2022 wondering if I did do it right. So the point here, the takeaway from this is you can do it before the end of the year. I would say that if I put a clock on it, you call your accountant and make sure that, that your accountant or your CPA is on top of things, or if you're using TurboTax or whatever, it probably can't take more than just a few minutes, but it's really worth it. Okay. Number 2, big tip before the end of the year that we can do.
Number 2, time to consider making a charitable donation. I know everybody is always, thinking about, they're unable to do it. Finances are always tight. But, there's a lot of good organizations out there who really depend on everyday individuals for their mission. And I really do want to stress, I work with a lot of charitable organizations too, is that, it doesn't matter how small the donations are, it does help. Every dollar helps. And I cannot encourage people enough to do this.
But Eric, in addition to, you don't have to be rich to give and to benefit tax-wise, just as a little incentive for people to make that contribution to their favorite cause before the end of the year, what is the tax benefit for those who itemize and those who don't?
So great question, Pam. So in the 2021 tax code, there is a place where you can take a deduction, which is a reduction on your taxable income when you make charitable donations. It is dollar for dollar reduction on your taxable income up to $600 even if you are not itemizing. If you are itemizing, then it does go to kind of the itemization type of rules. One of the great places to check out, charities is this place called Charity Navigator. It is a nonprofit organization that aggregates data about the different charitable organizations that are out there. So this allows a donor to really vet these charitable organizations to figure out how much these charities are spending towards their mission. And I know that's a very important piece. People want to give, they want to give in a well thought out manner.
That's right. Okay, so the takeaway from this is if you want to make a charitable contribution, you can make it count on your taxes. It can reduce your taxable income. That's a big benefit. Got to do it before the end of the year. And here's the link right to the website so that you can actually check out the charity just to make sure you're comfortable making that contribution. So we're doing everything we can to give you the reasons why giving can not only help others, but also give you also a tax break at the same time. Okay, number 3 on the list.
Number 3 is really taking a look at capital gains. So, financial markets have been, going up for the past decade, if you will. And a lot of times you end up with what are called capital gains. Capital gains is mostly defined as a profit from the sale of an asset. Okay, so if you bought a stock, sold it, bought a house, sold it, these type of things, you may have what's called a capital gain. Okay, and capital gains are taxed. Okay, so part of it again is to review things by year end. If you have a capital gain, consider what other assets you have or that are available to you. If you have an asset which is you have a loss on, but you haven't realized that loss, consider selling that asset to use the loss to offset the gains. Okay, something like this, again, it's paper, moving money around on paper, but it does make an impact on your taxes. Because why pay capital gain tax on something when you can take active steps to reduce that capital gain amount. But again, the deadline to do this is by December 31st.
Okay,
So
Eric,
again, time to take action if necessary.
Okay, we have seen nothing but a stupendous stock market for the past 12 years. We have seen nothing but new record highs in the stock market, in our 401ks, in our 403bs this past year. I think there have been something like, it's mind blowing. I think there have been 70 or more new highs that were made.
Yeah.
That means a lot of people have profits in stocks or stock funds. And maybe you're feeling like you have
I think we froze for a second
winners. You know that expression, take some money off the table, guys, take some profits. So Eric, can you just walk me through quickly a very quick example in the real world of how you would do this for one of your clients right now?
Yeah, so that's a great point, Pam. As the market is making these new highs, if you're a holder in a mutual fund, you may be subject to what are called capital gain distributions, where the fund is distributing these capital gains to you. And these gains can be very, very substantial. So all you have to do is take a look at your other holdings. What holdings do you have that have a paper loss? And by paper loss, I mean it's unrealized. You bought an asset, it's down in value, but you're still holding it. There is a difference between what is called unrealized and realized. Unrealized is exactly that. It's down, you're still holding it. Realized means you have realized the sale, and therefore you have locked in a gain or a loss. And really it's about realizing losses, not paper losses, realized losses to offset the gains. Okay. And this is a way you can actively reduce the amount of taxes that you owe on the gains. And it's an important step because, again, some of these numbers are very, very substantial.
And this is why talking to an advisor, I'm not doing a commercial for you, Eric, but I am just saying in general, it's really worth it to talk to an advisor who has this tax focus, because you want to look holistically at everything you have. You don't want to just look through one lens at returns on your investments without looking at, well, what does that mean for me tax-wise? It all has to, it's like a domino effect. Everything has an effect on each other. So it's really important to pay attention. And you know what, if you can't do that this year, this is something that you can just kind of jot down that for next year, you can do it for next year at the end of the year and so forth. Okay. So number 4 out of 5 on the list of top smart money moves to make before the end of the year.
You got it. So number 4 is really taking a look at what are these called Roth conversions. Okay, so there's 2 kinds of IRAs. One kind of which is called traditional IRAs, which when you make a contribution to the IRA, it is tax deductible. And then when you take money out of the IRA, it is taxable to you then. And a second kind, which is called the Roth IRA, in which you make contributions which are not tax deductible, But when you take a distribution from there, the distributions are not taxable. So there's a good way to think about it in terms of the IRS. IRS taxation rules. You pay tax now or you pay tax later. Okay. So traditional IRA is you pay tax later. The Roth IRA is you pay taxes now. Okay. So there's a strategy involved with these traditional and Roths, because the Roth IRAs, you are subject to what are called income limitations. If your income level is too high, you can't contribute to them. Okay. But there is a backdoor way of contributing to these Roth IRAs, with taxpayers contributing to what is a traditional IRA and then converting it. Okay. This strategy, advisors like myself have been utilizing it for 10 plus years. There is current pending legislation in Congress today that will disallow this strategy for going forward. Okay, so as I'm talking to my clients, I'm telling them, 2021 may be the last tax year they're able to do this. If you have the ability to do it, implement this strategy today. Do it before the end of the year.
Wow. Randy, I bet you get a lot of questions from credit union members about Roth IRAs and Roth conversions, because it's such a big topic.
It's a complex issue, and the rules are evolving. And right now this bill has passed the House, but it has not passed the Senate. And it's, right now it's tough to know what the rules are going to be, but why not take advantage of the rules while they're still in play? That's the thinking process with our clients.
Randy, do you get a lot of questions about that?
More of the questions we get from our membership are, how do I liquidate my 401k at retirement?
Yeah.
That's the primary thing that I'm hearing from our members when it comes to like their wealth management journey, is that time point. Personally, I'm more worrying or wondering if the holdings I have within my own retirement account, right now it's pre-tax. So should I switch it to a Roth now? I don't know. I really don't know what I should do there, but that's, but from the member,
That's a really good point. Your question is really funny, because what you're saying is that a lot of the members, and we will get to the questions and answers at the end of number 5, but I'm breaking right now for a second on purpose, because Roth IRAs are such a big deal to people who are rolling over. And Randy, a lot of times when people are getting ready to move their account from their 401k with their employer over to their own IRA, that's the first question they ask. And you're asking the question yourself. How do I really know? So Eric, maybe it's worth it just for a quick second to kind of answer what Randy's asking.
The answer there is it really depends. It depends on, your circumstances. Where are you today? What are the goals you're trying to achieve? And what are the best pieces? What are the best action steps for you to take today to ensure you meet those goals? These conversions, especially when they're taxable, can be complicated because if you were to convert from a traditional, like a 401k, over to a Roth, the amount you convert is considered taxable income. It's taxed at ordinary income rates.
That's right, because you never paid taxes on that money, guys, in the first place. When it first went into your 401k or your traditional IRA, remember, you got the break that all of the money went in, none of it went to tax. So now is the time when you have to pay. If you're going to convert, you have to pay. You have to have the cash available to pay the tax.
Correct. Because
so will the IRS charge you all in 1 year? So let's say, you liquidate or you do a conversion and you're over to a Roth, and all the money that's in there is now taxable. Do you have to pay the income taxes on all in that same year, that year of conversion? Okay. Yeah.
That's why, it's really circumstantial. It really depends on the circumstances. I'll give you kind of a classic scenario where it may make sense to convert. Somebody who is retired, they have a relatively large mortgage, and when they stop working, they have no more income. So there's deductions they can utilize on the mortgage side, and they can convert up to that amount tax-free. Okay, so there are strategic type of steps you can take to really minimize the taxes And that's why it's so important to really understand what people are trying to achieve and where they are today, and figuring out, where the pieces are and how to move it about in a most optimized manner, because you don't want to do a blind conversion, without really understanding what the taxes are, because it can be painful. Like you just said, if you convert all that 1 year, it is all taxable that year. Okay.
Right.
And
So
with higher.
Yeah. So, I mean, as far as the ideal candidate is going to be someone who can afford to absorb that tax bill right now, and that it's just a way to optimize their going forward to get you into a lower tax bracket, especially for people who are getting close to retirement, because the last thing you want to do is be in a high tax bracket after you retire. So this is a way, especially with the required minimum distributions, and also that can impact Medicare without getting into great detail about that. So it's just enough to say that that's why the Roth conversions are so popular. But you've got to take in, again, got to take in the whole picture. You can't just look at it through that one lens. You have to look at your whole picture. Eric, what's number 5 of the 5 tips for what we want to be thinking about doing right now?
Number 5 is really, so 529 plans. 529, so let's define what it is first. So a 529 plan is a tax advantage account for higher education. Okay, so if you have a child that you want to save money for college, a 529 plan is a way for you to do it. And the closest thing there is that's comparable to this is the Roth IRA. Okay, when you make these contributions, you do not receive a deduction, or at least in California, you don't, I should say, because there are certain other states that allow you to take a deduction, but in California, you do not. Okay, the money goes in after tax, it grows tax-free, and when it comes out for qualified educational expenses, you do not pay any tax on the growth of the money. So these 529 plans is a powerful way to save for education, post-secondary education expenses. And the reason for making these type of 529 contributions before the end of the year is, again, these 529s have a contribution limit, and these limits reset every January. Okay, so if you do it now, you also have the ability to do it again in January. So this is just a way to really maximize things for you over time. And Pam, you alluded to this earlier. When it comes to these strategies, it is not one decision that you make in one time that changes your trajectory for the rest of your life. Finance is really a game of inches. Okay, you do the right thing and you repeat it year after year after year. That is really the most successful way to implement these type of strategies. And these top 5 things are again things that we're doing with our clients before the end of the year, but they are designed to be repeatable year after year, because that's really how you make a difference in the trajectory of things.
Yeah, Eric, I really like the way you put that. You said a game of inches. In other words, just little changes incrementally over a long period of time, whether it's habits, behaviors, just getting into the routine of doing what we're doing right now, just getting into the routine of knowing that, and we're in December, before the year closes out, while you still have a few days left, take a look at these 5 things that can make you feel like, okay, I checked off these boxes. I either am going to do something about it or I'm not, doesn't matter. Just the idea is get these habits down. I love that game of inches. We promised that the presentation part would be around 20 minutes, and we're pretty much right there, which is fantastic. What I would like to do now is I want to be able to hear some of the questions, and we have gotten a couple of questions, and one of them is Kimberly, who's just came in right when you were talking about the 529s, because she's saying, I've been reading about the 529. I have one child in kindergarten, another under 3. Oh, good luck. I've read that 529 plans are the best way to help pay for their college. Oh, okay, this is a good question. How do I know which plan to pick? There are different plans. So how do you go about choosing? They're state sponsored, and every state seems to have a different 529. Do I have to, like, if I live in California, I can only put money in my California plan, or how does that work?
So the 529 rules really allow you to participate in any plan. As Pam, you pointed out, there are state sponsored, which means there are 50 plans in the US to make these really, really complicated.
Yeah.
Okay. Generally, I think a good place for people to start is with the state that they're in. They are not required to participate in the state that they're in, but generally that's a good place to start. Okay, is the state that they're in. If you're a California resident, the 529 provider for California is TIAA-CREF. Okay, the website for that is I'm drawing a blank here. I apologize.
Well,
We'll post that up later. But the TIAA-CREF, the things you're looking for is low cost being the key. When there is a high management fee involved with these 529s, it's going to hurt the returns. So you as the investor want to seek the lowest cost plan out there, or one of the lowest plans out there.
Okay.
And the California one ranks high.
I'm Kimberly. I'm in California. I've got my 2 children and I want to start doing this and stocking money away. There are tax benefits. I think of it like an IRA account.
Like a Roth,
like a Roth IRA, even better. I don't have to pay tax later if I use it. And there's other benefits too. Okay. So now I have to pick the investment plan. I've got 50 to choose from. Short, like right down to the bottom line. I know these plans get ranked all the time. What do you see as like the top 1 or 2 or 3 that people who live in California or live in Idaho or live in Massachusetts can also participate in? Because there are some that are better than others.
Yeah, some ones are better than those. You're exactly right. I think the Utah plan ranks right up there. I think the Utah plan is a Vanguard set plan. So it's available nationwide. That's one of the plans I commonly recommend. For California residents, I typically use California. And then if there are state specific rules, I have a client in Alabama as an example. As an Alabama resident, if they contribute to the Alabama plan, they actually receive a tax deduction. So in that case, it may be better for them to utilize that state's plan.
Well, what are you doing with your kids?
I don't have any children.
What are you going to do with your kids, Eric?
California. Yeah.
You are.
But yeah.
Well, that's interesting. But that's interesting that you say that, because I know that they are ranked, and I'm looking right here online, and I can see that Utah always comes up number 1.
Yeah.
So why is Utah the one that people always say is the best one? I know what you're saying about I can get the deduction. If I can get the deduction, I want to do that. But what is it about Utah that makes it so interesting?
It's the fees. They have one of the lowest cost plans out there. And that's why I was saying earlier is you as an investor really should be fee conscious, because fees detract from returns. And you know, when you throw in compounding over time, a small incremental increase in fees can have a huge impact on investment returns. So investors really need to pay attention to fees. And the Utah plan, as you pointed out, is one of the best ones out there because it has one of the lowest fees out there. The California one's not far behind. I don't want to say California is bad, because like I said, personally I probably use California, but Utah plan is certainly right up there.
Okay, sorry to put you on the spot with the kids.
No worries.
Okay, let's go to the next question. Wade B from Modesto is asking, Eric, is there a certain age when the Roth IRA makes more sense than putting money contributing to a regular traditional IRA?
I don't think age is necessarily the quantifier. I think it's centered around taxes. Because when you're putting money into a Roth IRA, the contributions are not deductible. In a traditional IRA, they are. If again, assuming there's no employer plan, et cetera, et cetera. Okay. But when you're thinking about traditional versus Roth, you really should be thinking about taxes, because again, the IRS rule says you pay tax now or you pay tax later. So the idea to really best utilize these vehicles is to pay taxes when your taxes are low. Okay. So as an example, if your income is low today, you may want to consider the Roth, because again, your income tax bracket is low.
Okay, Eric, could I say it this way then? Because when I look at my income, let's say that I'm not 38, but let's just pretend I am. And that I feel like I don't know if my income is going to be higher and lower. I feel like I'm making a lot of money now. How am I going to know if it's higher or lower? Maybe one way to think about it is that the tax bracket that you're in, at what tax bracket do you start to feel like it's not a slam dunk? Is it like 24%? If I'm in that kind of bracket, I have to not just jump into the Roth. I need to actually stop and say, okay, it's not about age, it's about tax bracket more than anything else. So what's the tax bracket that you say kind of puts a
The bracket I use for most of my clients is you're exactly right, in the mid-20s, because that's on the federal level. You have a state level on top of that. Okay, so combined, if you're in your mid 20% tax bracket on the Fed side, with state, you're probably looking at close to 30%. Anything beyond that, really do consider the traditional versus a Roth.
Because in that case, with the traditional, I'm getting the benefit of having the money. I didn't have to pay for taxes on the front end. Instead, get invested, and assuming you're investing at a low cost, accumulating over time, and then I actually wind up better. So I think that that's a really good guideline, because I'm always thinking about that same question that Wade just asked about age. Okay, I think we have time for one more question, maybe two. I'll try to squeeze in two if I can. Okay, this is Donna. Okay, she's 43. She says, I'm making a pretty good income. I have almost all my money in the stock market and in my 401k at work. What should I be worried about for this next year? I mean, we've got, obviously, we're not going to get into a big discussion about the headwinds of inflation and all of that. But Eric, what are you telling your clients when your clients are already positioned, but what are you telling prospective clients who are coming to you with this question about what are you worried about for 2022?
I think that the first one is really, really think about this financing in terms of the games of inches again. She's 43. The best thing she can do is really maximize retirement savings. Regardless of how high stock markets are, where we are in terms of the economy, there is no substitution for savings. So if she's a participant in her company's 401k, she should continue to participate and really figure out what is the maximum she can contribute to that 401k. That is going to make more significant difference versus how she is invested, as an example. Regardless of where the economy is, whether stocks are high or stocks are low, et cetera.
Okay, Eric, I've got a question. Randy was raising his hand because he wanted me to know that he has a question. Randy, do you want to read the question, or do you want me to? From a member.
Yeah, but yeah. So we have a lot of first-time homeowners right now. So this is more of a tax question, but what are, typically when you become a homeowner, you can itemize your deductions on your taxes where you couldn't before. So for that first time homeowner, what are some of those typical things that homeowners forget about? I know what comes to mind is like, writing off the interest on your mortgage.
Yeah.
But besides that, what are some of those other things that, usually don't realize until you've been a homeowner for a few years?
I generally recommend people to do these tax projections to model out the taxes with the home ownership. So, as an example, if people are doing TurboTax, which I know a lot of people do, enter in your tax year 2021 numbers in your TurboTax 2020 software. Okay, you can do a projection fairly accurately, as with this state of home ownership in mind. What is the interest that you're going to pay on your mortgage? What are points you may have paid on your mortgage, et cetera. So these type of deductions will certainly impact taxes. But the only way to find out how they will impact taxes is doing the tax projection. I always recommend a tax projection. Going to one of my earlier points is really avoiding surprises. Nobody wants to get a refund back, even though that may feel good, but all you've done is given the IRS an interest-free loan, so really try not to do that if you can. Okay. And nobody wants to owe either a large dollar amount. So, try to be as even as you can. And the only way to do that is to really do these tax projections and make correction changes along the way. Okay. If you find out you're over withholding, start adjusting your withholding. Okay. If you're under withholding, what do? Start adjusting the withholding. And sometimes, if the incomes are high enough, they may need to make quarterly payments. Which is just an extra check that they can write to the IRS to true up the taxes as you go along.
Okay. When you're using TurboTax, by the way, I mean, how complex is it if you are itemizing, you have a home, how easy or how hard is it, Eric, for people to use that software who are, new homeowners, especially to separate out what is deductible from what's not deductible?
Not too overly complicated, because on most mortgage statements, they'll tell you how much you've paid in a year.
True.
So if you look at your November mortgage statement, it'll give you a fairly accurate number. Okay. So based upon November, add a month of December to it, and then put that number into TurboTax. TurboTax is I don't want to say it's easy to use, but it's doable. It's doable. Okay, so as you go through, you go through TurboTax and use the walk me through step-by-step piece, and it'll ask you the questions and just input in, like I said, 2020, your actual 2021 numbers within tax year 2020 software, because the 2021 software is not out yet. It won't be out until next year, early next year, I should say. So you can do a fairly accurate projection by utilizing the last year's stuff.
Okay.
Right. Numbers change every year, but it's close enough, because again, on taxes, you're never going to be exactly on the ball.
Okay.
You're not going to get it to the dollar.
Okay. So any last thing that you would say that absolutely someone has to do by December 31st to make the itemizing pay off?
I think it's if you can only do 1 out of the 5 here, I would say do the tax projection. That's really the key. Is really understand what you're facing, and that's the best way to prepare for things, is really understand what's going on.
Okay. Can this be a quick check-in that if someone is actually working with a CPA or a tax advisor, that they can check
Absolutely
at the end of the year? Okay, it's not too late. All right, that's really important, and that was a great question, Randy. Thank you. Okay, I want to stay true to us keeping this nice and sort of brown bag lunch contained, but I do want to get this one last question in. This also kind of reminds me and harkens back to what we were saying earlier about, when you're working with an advisor, and that advisor's job is to look at everything holistically, taxes as well as the investments, as well as inflation and things you can't control. Things you can't control that happen in the economy. If interest rates do wind up, going up next year to whatever extent, you can't control those things. So it's all taking into consideration all the things you can do to position yourself and fortify yourself and get yourself bulletproof. So this one last question, this came from Nella, and she says, the woman, I guess that's me, says that you are a fee-only advisor. What if I just want to pay you to make sure that I'm not going off track? What does that really mean when you say fee only? How do you work with clients?
So we work with our clients in a couple of different ways. We do provide financial advice for fee. In those cases, we charge hourly. We also, second way we work with our clients is we do financial planning with assets under management as well. And in those cases, we generally charge a percentage of assets under management.
So when you say assets under management, for people in the real world, what you're saying is that people can ask you to look into their Schwab account or wherever they keep their money, their savings, and actually have you do the rebalancing, and you are the one that's actually taking care of the tax loss harvesting at the end of the year. So they're kind of giving some of the control, not all of it. The money is not in your possession. It's at a custodian, but giving you they're paying you to manage that portfolio for them. That's what you mean by assets under management.
That's exactly right. That's exactly right. Okay. So back to her question here is, go. Yes, Randy.
I was going to say to recapture that person's question. I think what she's saying, and maybe you answered this, but let me ask it again. So if I am already working with somebody and I am going in this direction, I could kind of take a timeout or say, hey, Eric, this is what I'm doing with somebody else. Can you, just give me your opinion? Does this look like I'm going in the right direction?
Yeah.
Could you do something like that? And how do you charge for that? Is that where you just charge per the hour?
Correct. That's exactly right. So generally what I do with people that are looking for a second opinion or, just as double checking, I like to understand, what are the things you want us to look at, and really try to define that scope of work. And with my clients, I can generally estimate what that is going to be. I've been doing this long enough. I can gauge it down to X number of hours. And for most clients, I typically do a, do not exceed, just to have protection mechanisms built in as well for the client. And it'll just be, scope of work, number of hours times hourly fee. And that's kind of the how we work those type of arrangements, if you will.
Well, that's good. I appreciate the flexibility with that. And there's a lot of people, Randy, that are asking the same exact question about, how do these advisors get paid? Like advisors like Eric, who are only paid by their clients because they don't earn commissions to sell insurance to you. So they're really, truly, purely paid for their advice and guidance, which means their loyalty is 100% to you. Just a quick second before we wrap, Eric, I'd like to kind of know from you personally, why did you decide that you wanted to be fee only and fiduciary, meaning you're legally held to the fiduciary standard to act in the client's best interest? I mean, what was that about, that decision for you?
I think, my opinion, it's the best way to do business. There is complete transparency in terms of how advisors are paid if they are fee only versus sales. As I always tell people, if you don't know how people are being paid, is you're most likely getting taken advantage of. That's just, there's no free lunch out there. I'm an economist by heart. I truly believe that there's no such thing as free lunch.
And
so
also,
by
oh, sorry, I was going to say your goal is the same as the client's goal. You're on the same side of the table, so you want to keep those costs down. We touched on how important it is to keep the fees and expenses when you are investing your hard-earned money, to keep those as low as possible. So you're actually really interested in making sure that you're the cop on the beat to make sure that those fees are as low as possible.
That's exactly right, because future returns are hurt by high fees. So our incentive in working with our clients just to make sure that we understand what the fees are, because everywhere there are fees, is just to make sure you minimize these things as much as possible. And I decided to be on this side of the fence because I believe that people should be able to get reasonable help without getting fleeced. And unfortunately, I've been in the industry long enough. I've seen a lot of bad things. And I can only control myself and my firm. So we try to do all the best that we can. And we take that to heart. Again, like you said, it's a different legal standard. And we are by law required to place our client's interest first. But that's not how most firms do business, unfortunately.
No, it's not. It's not. 90% are selling products. But we'll get into that another day, another topic. But right now, we promised that we were going to kind of keep this contained to well under an hour, more like 45 minutes. So we're pretty much there. And I just want to say thank you so much for participating, and thanks, Randy, for hosting this, and thank you for sending in, your great questions. And I want to remind everybody that when you go to Rolling F's homepage, you'll see wealthramp.com right there, and you can click on that when you're ready. We never tell people you need an advisor. We tell people when you decide you're ready to talk to an advisor, don't go anywhere but us. And then that's when you can just click and start to have a conversation with the advisors who are the best fit for you. And Eric is in our network. He's included in our network. So thank you, Eric. Randy, I'll let you take us out.
Yeah, I just wanted to remind the participants that within the Wealthramp, I guess, umbrella of advisors, we do have several that speak Spanish also. So I know coming out of Foster Farms, a lot of people have worked there their entire career and still feel comfortable doing, those large financial transactions in their first language. And so Pam has found fiduciaries that pass her standard that are bilingual.
Yes.
Yeah, so that's
And
a
with
good
that,
thing.
I say Feliz Navidad.
Feliz Navidad. All right.
Well,
Muy
thanks
bien.
everybody for joining us. And, I think we should do more of these in the future.
Yeah, I do too. Thanks, Pam. Thank you, Eric.
Thanks for having me.
Okay.
Take
Bye,
care, guys.
everybody.
Merry
Bye-bye.
Christmas, guys.
Merry
Bye.
Christmas.
Happy holidays.